Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Jason Loy, who is head of APAC Equity and Derivative Strategy at BNP Paribas. Hope springs eternal, except maybe in China at the moment. You know, there's been a little bit of skepticism because we've had a lot of false dawns on stimulus in China. Even though this latest round of stimulus seems to be really right across the board, and it did create a lot of enthusiasm. So was yesterday's selling in the Hong Kong market a sort of alarm? Was it a signal that investors are losing confidence, or do you think that confidence is still there?
I think that's a fair question because indeed we did experience one of the largest sell-off in the index history. But we also have to look a little bit back just to put things into perspective as well, because during the Golden Week while China onshore was closed, Hong Kong became this kind of placeholders for all of your China optimism for about 7 calendar days. And so with that, the market was up about 10 to 15%. So what happened yesterday is that we've unwound all of those rallied during the Golden Week. So it's basically that we have a reset in terms of expectation. It is true that, as you mentioned earlier, that the market did get excited about this new round of stimulus, given that there are a few innovative new policies being outlined. But we still have yet to see the bulk of it being implemented. So certainly the NDRC briefing yesterday may have delayed some of those optimism, at least in the very near term.
I'm wondering whether a lot of this is new long positions or just a big batch of short covering. Which is it?
I would say probably a combination of a few things. So first of all, I think initially, if we go back to middle of September, where the rally first started, I would imagine that the first part of that feels like a short covering. I think as we move closer and closer to the latter half of September, especially after the joint press briefing between this PBOC and the financial regulators, what we observe is that there's a lot more genuine money coming in to go long. And this is also true if you look at the China ETF listed in the U.S. So, for example, if you take a look at FXI, between middle of September and early October, as of, I think, yesterday, because today's number is not out yet, we've actually seen more than $4 billion worth of inflow. Just to contextualize that, that is greater than the sum total of 2 of the largest India ETF in the U.S. year to date. So it shows that there is this rapid shift when it comes to investor sentiment, not just in Asia, but also in U.S. and globally.
Jason, a moment ago, you referred to innovative ideas, some new innovative ideas in China. What are those to you?
Sure. I think the two came from the PBOC facility. So PBOC introduced 2 new things. First one is a 500 billion renminbi worth of security swap facility where financial institution can swap their holdings with the PBOC in exchange for high quality and liquid asset where they can use to finance their equity purchase. The second is a fixed rate loan that will allow corporates to buy back their shares, both of which are very new. We have never seen anything like that in previous capital market reform. They are probably also borrowing the spirit from some of the other corporate governance or capital market reform that we have seen in the past. So, for example, we know that central banks like Bank of Japan has been buying ETF during the Abenomics era. The PBOC does not want to buy ETF directly, but with this swap facility, they are allowing the financial institutions to increase the equity exposures. On the buyback side, we have seen Western companies opportunistically take advantage of the low borrowing costs in the debt market to buy equity, and they're trying to do the same in China.
Yeah, just briefly, Doug, before we go, this is mooted by the PBOC, but it's not confirmed yet, right?
In terms of the policy, they are confirmed because the governor of the PBOC announced it at the joint press conference. What is not known are the details, i.e. who can borrow, what are the terms, what are the duration, and things like that.
So I'm curious, Jason, in terms of what you're hearing from clients, whether they have bought into this idea or whether there is still a fair amount of healthy skepticism.
I think based on a client conversation, clients do believe that the government is committed to stimulate between now and year end. And this is actually reaffirmed by the NDRC press briefing. What is still a little bit unclear to us is what about 2025? Because part of the reason why investors get very, I would say, pessimistic heading into September is because the Chinese policymakers seems to be prioritizing national security over growth.
Yes.
And so until they see a meaningful shift in the narrative or the language from the policymaker on the medium-term goal, perhaps there's still a segment of the investor base that are still a little bit skeptical regarding 2025. But I think for the rest of the year, certainly they feel that the government will try their best to meet that official target.
Yeah, so that's quite critical what you mentioned there, because you've got to believe that Xi Jinping believes that this is important. This is the new direction. So are you a buyer here or are you cautious?
I think depends on which market we are looking at. So right now, if you look at the China onshore market, despite that, I think we had a roughly 18% reversal between Hong Kong and China Asia yesterday. The onshore market is still underperformed Hong Kong by about 6-7% year to date. So I think in the near term, that gap will likely close as we see more and more domestic investors shifting away from cash and bond into the equity market. I think into 2025, then it requires a fundamental shift in terms of the broader growth, which will learn from the annual economic work conference in mid-December.
All right, Jason, very good stuff. Thank you so much for coming into our studios. Jason Loy there, head of APAC Equity and Derivative Strategy over at BNP Paribas.
Bloomberg Opinion, informed perspectives, and expert data-driven commentary on breaking news.
We're joined by opinion columnist Shuli Ren, who's writing about China's recent round of economic stimulus. Shuli, thank you very much. I can just sort of say here, Shuli Ren to Xi Jinping, don't get cold feet now. Explain.
Well, the market was very disappointed by this very high-profile media briefing from the national, the NDRC. Basically, it's the China's national economic planner. I don't know what some traders were expecting because it's really not NDRC's job, but they were hoping that at that briefing there would be $1 trillion stimulus, fiscal stimulus numbers being floated out, and they didn't see that.
So does this really pave the way for a lot more from the government? I mean, in the near term here, or is it kind of reached a critical situation where if authorities don't do more, the market is going to kind of take them to task, as it were?
I think the authorities have to follow up at this point. I mean, NDRC, granted, it's not their job to flow out those big stimulus numbers, but the Ministry of Finance is expected to hold a press conference, and then the State Council as well. And recall when China had a big stimulus measure in 2008 after the global financial crisis. It was Wen Jiabao, the premier of China back then, floating the 4 trillion yuan number. So people are actually expecting that sometime this month. I mean, by the end of this month. And if it's not happening, this rally will completely fizzle out.
We did get some innovative ideas that were rolled out before. The announcement by the PBOC of that swap facility for $500 billion, and then also another one for $300 billion, where companies could borrow to buy back shares. This got a lot of attention from investors. Is that, in your mind, is that an idea of innovation? And do you think that there's more where that came from?
I think it's interesting, right? That PBOC entering the bond market just a month ago was already considered innovative, and now it's considering providing infrastructure to help state-owned entities to prop up the stock market. That's definitely very innovative, and that's why investors are so excited, because they think China is really bringing the big guns out. I mean, it's not just simple rate cuts or reserve ratio cuts, that announcement itself, they haven't set up the mechanism yet, and we don't have the details as to who can tap onto those swaps facilities. But the fact that they talked about it at all, it shows that this time the government is serious. They are trying to, reboot the economy.
Yeah, but they're in a very tough situation. I mean, you reboot the economy by borrowing a lot of money, and at some point, the credit markets are going to have something to say about that fact as well, right?
Well, we all know China's credit market is not that real. A lot of the credit is actually held by the big state-owned banks. And let's be frank, these are now commercial banks. These are policy banks. And China is talking about, we heard the announcement, China was talking about recapitalizing the big banks. Again, it was a big gun out.
Back to the original point, investors are skeptical about these types of developments in China because, they've had their fingers burned many times before. So, you're saying don't get cold feet to the president. Do we see a real buy-in from him on this? I mean, did they reach that sort of pain threshold that Goldman referred to?
It seems like it because they had the top policymakers, they have 4 meetings, the Politburo meetings a year. And then in September, they usually talk about other stuff like politics, social affairs, and etc. But in September, they actually discuss the economic situation. And then after the meeting, in the readout, they talked about boosting fiscal spending. That is very, very unusual. And that meeting is chaired by President Xi Jinping.
So is it possible that this really does kind of shock consumer sentiment, small business sentiment in China in a positive direction, or might that also fail?
I think having anything at all, like the fact that the stock market is responding at all is good news. I mean, really reflating the economy is going to take a lot longer than the stock market rally. But at least, basically, the Chinese economy has been very sleepy for a year. And if they don't do anything now, the government is literally sleepwalking China into the next Japan. The animal spirit will be out. We'll have decades of deflation. They really have to do it now.
All right, well, we could go on, but we'll have to save it for another day. Opinion columnist Shuli Ren with us here in our studios, because I did want to get some ideas from you about Li Qiang reaching out to the experts and academics. We'll do that on another day. You can read more on Shuli's piece and other pieces from Bloomberg Opinion at bloomberg.com/opinion and on the terminal by typing OPIN GO. Joining us now on the program is Noel Dixon, Global Markets Macro Strategist at State Street, for a closer look. Noel, thank you very much for coming in. I wanted to ask you first about the U.S. economy. We can circle back to China in a few moments. The non-interest rate drivers in the U.S. economy are multiple here at the moment. We mentioned that we just saw the cut in New Zealand. Are those drivers in the U.S. economy, the tailwinds there, is that almost enough to make it sort of not matter too much about whether the Fed cuts interest rates from here?
Yeah, no, I think the Fed cutting rates is still going to be important for the U.S. economy. I think it's interesting. I mean, it's quite unusual for them to be cutting into strength. The only analog you could probably think of is 95, and that was actually a pretty decent time for risk. So I think interest rate cuts is definitely meaningful for the U.S. economy.
Yeah, but I remember the bond market doing a lot of work for the Fed back then, right? Could you make the same case now that the market rates have really done a lot of the heavy lifting?
Yeah, no, I think definitely the market front ran the Fed, as they were signaling in their guidance in the SEP. Now things are probably different, and I think the next question investors are going to have to answer is, where is the terminal rate? And I think that's basically where we're headed in the next couple of months.
So I mentioned the tailwinds, but we have a lot of headwinds too, particularly with geopolitical tensions, with kind of instability to a certain degree in and around China, both with the economy and also relations with the West, and obviously the Middle East and the possibility of a bigger war. When you weigh up the headwinds and the tailwinds, does it come out, are you positive or are you concerned and worried?
I would say I'm a little worried, but I think the biggest concern, of course, is if the situation in the Middle East really continues to escalate from here. We already got a pretty big move in energy prices, and if that continues to be, if we get a nonlinear aggressive move in some commodity prices, that can definitely offset some of the progress we've made, I would say, not just U.S. inflation, but global inflation. I think a lot of the progress has been from the acyclical side of inflation, so that's the part central banks basically don't control. And if you get a reversal in that, that could be problematic.
What is the probability of something like that occurring in your work? I mean, do you think that we could see kind of a resumption of inflationary pressure building?
It's possible. Again, the Middle East, of course, that can drive energy prices. I think, like I said, the Fed's cutting into strength, and then you have China on the other end implementing stimulus. So across the board, I think you're getting this liquidity injection, and that being augmented by higher energy prices could certainly reverse some of the progress on inflation.
Noel, when we talk about headwinds, we haven't mentioned the election yet. And I suppose in asking the question, obviously there are a lot of people that feel very strongly about this. But for people like us, journalists and strategists, you're trying to take a more neutral or nuanced look at things. Do you see the election as a potential challenge for markets or perhaps as a boon?
I think it could be in the near term. If you look since the 80s, you always get a risk premium baked into markets. You look at the 7-day moving average of the VIX or the MOVE index. We always get this sort of spike into the election. I think the results are going to be important. If we get a split Congress, regardless of who wins, I think we're in good shape. But if you get, say like a red wave, I think you could start to get questions about the U.S. fiscal position. And then regardless of who wins, I think they both plan to spend quite a bit of money. So it's difficult for me to see how there's not a floor under the long end of the U.S. curve, and that could have implications.
So, Noel, you're normally based in Boston, from what I understand. What's the mission there in Hong Kong on this trip?
Yeah, so in Hong Kong, the main mission is basically to communicate here our sort of viewpoint from the U.S. as it relates to the election. A lot of investors out here are interested in the U.S. growth forecast, and is it a soft landing? Is it a no landing? Are we? I think there was a little bit of concern with when we had the tick up and we triggered the SOM rule. Mm-hmm. Is it actually different this time? So I think so it's basically the U.S. economy. What do we expect from the election, and what are the risky outcomes?
I'm curious what you're hearing from clients and from people that you talk to, and whether or not they're confident themselves in Hong Kong and China, or if they're not so confident and they're really looking to leadership from the U.S.
Yeah, I think the confidence level in China, I think, is precarious at best. I think there's, the PBOC, the Chinese government, they did a lot on the monetary supply side of things. Now the question is about fiscal policy. So I think we got a lot of high expectations as it relates to fiscal policy. So if they don't deliver, then I think there could be some room for disappointment in Asia markets.
Yeah, we just got word today that the U.S. federal budget deficit is at $1.8 trillion, up about $100 billion from last year. Is anyone asking for your view on the path of the dollar going forward? And if that's the case, what are you telling them?
Yeah, absolutely. I think the dollar obviously is critical to Asia and EM carry. I think, our perspective is, we actually are constructive on the dollar fundamentally. If you look at the 1-year change and 1-year forwards, you graph that against U.S. growth. For us, it doesn't make sense that the U.S. has some of the highest growth forecasts, but they have the most amount of cuts priced in. So we think, obviously, to be fair, that's because of the Fed's forward guidance, but we think there'll be a convergence, and that in itself could be supportive of the dollar. And then also, we think terminal is probably or the neutral rate is closer to 3.5 or 4%, and that should also impact the dollar as well.
So we talked a little bit about your caution over the tensions in the Middle East and also with the election approaching. So I'm curious if there is anything that's getting Noel Dixon excited here. Is there anything that you like, any corner of the market that looks good and almost impervious to some of these hurdles? Yeah,
sure. So I definitely, I still like, tech, I think, is going to benefit regardless of who wins. Like I said before, I think it's I think it's a good opportunity to start to nibble on some dollar longs. I like probably going long dollar Swissy. I think I also think there's an opportunity eventually to probably start to look at some short dollar yen trades, as I think the Bank of Japan ultimately they're going to have to get to neutral, which I think is probably 1%. So those are some of the opportunities I've been sort of looking at. So those are some of the opportunities I've been sort of looking at.
Noel Dixon, global market macro strategist at State Street.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.